Hi everyone, in this video we're going to be looking at the tax introduction document with solutions. So we're going to go through some of these terms together. These are in your readings as well, but we're just going to talk a little bit more about them. And then I have some examples that we're going to look at. So we're going to be doing taxes, and we're going to do it in a couple different forms. One of the things we'll talk about are things like sales tax. Another thing we'll talk about are the taxes you might pay on your income. And so we have some terms here that we need to talk about so that we all understand what words we're using and what the numbers we see, what they represent. So the first thing that we'll see when we're talking about income tax is gross income. The gross income is the income you have before you take out taxes. So you could think of this as, if you get a job with a salary, this is what they'll say the salary is. So let's say you go get a job and your salary is $50,000. So you're very excited. You get a job, $50,000. Awesome, I have $50,000. Well, that's how much money that you get in gross. The problem is you have to pay taxes on this, so what you actually get after taxes will be less. So this is kind of the boilerplate salary. That's what the company is paying you. It's just that taxes are now taken out, so it lowers this amount in terms of the actual money you get in your pocket every week or when you get paid, whatever. So you can think of this kind of like your base salary before anything happens to it. Okay, so I said we're going to take taxes out. So there are two main tax systems that we're going to talk about here, and there are a lot of them that we could discuss. But the differentiating systems we're going to talk about, the first one is called a flat tax. So we're going to start here, and then later we'll talk about a different kind of tax, which is actually more applicable to us in terms of taxing our salary. But we're going to start with something called a flat tax. So a flat tax, it says, is a fixed or constant percentage tax. So right here in Dutchess County, if we look at the sales tax, we will see that it is 8.125%. All right, which means when we go buy something that is appropriate to have sales tax on, we are going to be charged an extra 8.125%. We have to pay an extra. So this is very important. This is an extra amount to pay. So when we're talking about sales tax, whenever you're talking sales tax, you're talking, okay, I have to pay this amount, whatever it ends up being dollar-wise, on top of the price of the thing I'm buying. So if it's 8.125%, we did this a little bit in Unit 1, you have to figure out what that percentage is of the price of your item, and then you add that on top. Okay? So sales tax, fixed percentage. It doesn't matter what the price is of the thing you're buying, we're going to always apply an 8.125% to that every time. Boom, boom, same thing. So because that sales tax doesn't change, the percentage doesn't change, we call that a flat tax. All right. So there's another type that we'll discuss a little bit later because our income tax is not flat. So depending on how much you make, the percentage you'll be charged in terms of your taxes is going to change. Not true for sales tax. Sales tax is flat. In Dutchess County, this is what you get every time. Okay. So after we've talked about taxing, we can then talk, if we start at gross income, after taxes, so this is we get taxed, then we end up with our net income. So this is how much you take home after we get taxed. So your gross income happens. This is kind of what your salary would be at your company, whatever, if that's your only income. Gross income, then you go through taxes, and then you get to your net income. So you pass through taxes, and there's lots of different things that go on with taxes, which we'll talk about some of them. But you go through your taxes, the government, the state government, the local government, the federal government take some of that money, You pay it to them, and then you end up with your net income. And so usually, unless you can avoid taxes completely, this is a smaller number. So this is a thing you should always be looking for. If you end up doing a problem where I ask you for your net income, and you know how much you start with, you should be looking for a smaller number, because taxes are taking away money from you. Well, so okay, maybe that doesn't sound too bad. Well, there are things that go into taxes that we have to talk about, right? It's not just as simple as pay this percent to me. So there are a few ways that you can change the amount you have to pay. And so the first thing that you can do to change the amount of tax you have to pay is called a tax deduction. So a tax deduction is something that lowers your gross income. So it doesn't actually take away from your gross income. But in the eyes of the percentage, the taxer, your gross income can be lowered by doing a deduction. So I gave an example here. Let's read it. It says, if you make $100,000 and I say have a tax deduction of $10,000, then in the eyes of the IRS or the taxing body, instead of $100,000, they only see you make $90,000. So then when they go get your taxes, they calculate it, you're not getting taxed on the whole 100%. They only see 90%, and so that's what they end up taxing you on. Okay, so a tax deduction here will lower the amount that you get taxed by just right off the top, you're taking away some of the money that you've made, and you're saying, nope, don't tax me on this. So a deduction lowers the income that the taxing body, like the IRS, even sees that you have. Of course, they know you have it. You're just not getting taxed. Okay, so if you've got this amount of money here, this is your gross income, then how would I apply a tax? I would take a percentage of this. But if you have a deduction, here, then what I get to do is, here's my deduction, D. I just get to chop this piece of my gross income off, and then the IRS or the taxing body, so the IRS as your example, only sees the purple. So they'll only see the purple to tax you. All right, so a deduction helps save me money by saying, you know what, let me put this $10,000 in this case aside. Let me put that aside, and I'm not even going to let you look at that, IRS. That's my money untaxed. Okay, so one thing to notice, just to kind of point out, if you are doing a problem, which we'll do a problem a little bit, a tax deduction happens right away. So a tax deduction is going to happen immediately. So when you start calculating these things, you want to know how much tax you're going to have to pay. Deductions come first. Okay, so you're going to see why I'm stressing that in just a second. Okay, so we have a new income. Our taxable income is the gross income minus deductions. Okay, so in this little picture I drew right up here, right, in this little picture, my taxable income would be the purple, this little shaded purple region, right? Because that's all I'm letting, again, we're just going to keep using the IRS as our example. That's all I'm letting the IRS see is my purple amount of money. So in the example above, so just to use the numbers, my gross income is $100,000 in my dreams. My deduction is $10,000. I'm saying, okay, I get to take that and I get to keep all of that. You don't get to see that IRS to tax me on it. So my taxable income would be my $100,000 minus my $10,000, which is $90,000. So this is what the IRS gets to actually look at to take a percentage out of, just the $90,000. Okay. So, what other way can I try to lower the amount of taxes I have to pay? Well, we've seen a deduction, which lets me take away at the beginning and almost like hide that. I'm not actually hiding it because it's known that I'm getting the deduction, but it lets me get to take some of my money and keep it completely untaxed. You could think of it that way. My deduction is some amount of my money that I've earned that I get to just keep without any taxing at all on it. So what's a tax credit then? Well, a tax credit is kind of at the opposite end of the spectrum of this process. So a tax credit, is an absolute dollar decrease in your tax bill. So you have to think about that sentence. In order to apply a tax credit, what do I have to know? I have to know my tax bill. What that tells me is the tax credit comes last. It has to come after my deduction. It has to come after I've applied the percentage to figure out how much tax to pay. So this is like a last step. Okay, so the order here is just different between these two. In a credit, I apply my money off after you've already told me how much tax I have to pay. In a deduction, it's before I do any percentages or anything. So here's an example. I owe $5,000 in taxes. So this is, they already took my taxable income and hit me with a percentage. I then say, look, I have this tax credit. My tax credit is good for $1,000, so actually I only pay you $4,000. So just to write that out in an equation, here's how much the IRS says, give me $5,000. You say, wait just a minute, I've got $1,000 credit. This is good for me. Credit helps me, that's why it's subtraction. Same with deduction. It's subtraction because it's helping me pay less. So I only have to pay $4,000. Right? So it's helped me out, just flat at the end. Okay, so how do we put this all together? So deductions and credits, they seem really similar, but where are they different? Well, here it says you should calculate your deductions first, then apply the tax percentage, and then what you can do is take your credit. So what does this look like? Step 1, apply your deductions. You could have more than one. So first you apply your deductions. Okay, so let's continue that example from before, right? So our gross income was $100,000, right? We had a deduction of $10,000, and let's say we have a tax credit of $1,000. Okay. All right, well, so we're missing one piece of information. We're missing what is our tax percentage here. How much are you taxing me? So we'll call the tax rate, and we'll make it a nice number just to make the numbers easier, 10%. So we're going to pretend this is a flat tax just like sales tax. So apply deductions. What does that look like? Well, I take my $100,000. Okay, I take away the deduction, which remember it's helping me. I'm lowering how much you're taxing me. That's $90,000. Okay. Step 2, apply the tax. Okay, so what does that look like? Well, you take your amount of money that's taxable. Remember, this is your taxable income. And you apply your tax rate, just like we did sales tax before. So actually, this idea is something we've already seen before in terms of sales tax. So you can think of it that way to start. This is $9,000. All right. So at this point, if there are no credits, the IRS is saying, give me $9,000. But you have a tax credit. Apply your credit. So you get to take this $9,000, we'll move this over here, and you get to say, hold on a second, IRS, actually, I have a $1,000 tax credit. So altogether, you pay $8,000. All right. Deduction, apply the tax, apply the credit. That is the order. That's the order every single time. All right, so what about the effective tax rate? So we can use that previous example, right? I have a little formula here, but we'll just use the previous example again. So the previous example, I said the tax rate was 10%. But did you actually pay 10% of your gross? So the question is, what percentage of your gross income did you pay in taxes? Because remember, we had a deduction and a credit. So I didn't actually get taxed on my full salary. I got to lower it by using deductions and credits. So the effective tax rate tells us, all right, take into account all of those things that helped me. What percentage did you pay? And so the formula is the amount of tax you paid. So let's apply it to the previous problem. We paid $8,000 divided by my original gross income, all the way at the beginning, $100,000. So we can put that in our calculator, and we end up getting 0.08 or 8%. Our effective tax rate was 8%. So even though, right, I'm staring down this tax rate of 10%, it doesn't mean I have to take my gross and pay 10% full to the IRS. I had deductions, I had a tax credit, so that lowered the actual percentage of my income that went to taxes. Okay, so an important piece, we have to be able to calculate this. This really tells us what was taken from our gross income. Because at the end of the day, we had $100,000 of gross. We ended up paying $8,000 in taxes. That left $92,000. Okay, so we've done some examples already, but why don't we do some more? See what it looks like to try to apply these ideas. Okay, so example 1. So I've got some solutions here, but we're going to talk through them. I get a job which pays $40,000 per year. I've got a deduction of $3,500, a tax credit of $800, and my state charges a flat income tax of 4.35%. Again, this will change later. We'll have another way of thinking about income, but for now, we'll start with flat. What's my gross income? So remember, my gross income is just what do I get paid by the company, forget about taxes. And so I make $40,000 per year. That's my income, no taxes applied. Well, what's my taxable income? Remember, taxable income, right, equals gross minus your deductions. Only the deductions, not credits yet, just deductions. Well, I got $40,000 to start. I get a tax deduction of $3,500. So then when the IRS actually is looking, or whatever group you're looking at, in this case, the state, right? So once they actually look at my income to say, okay, how much do you have to pay? They do not look at this amount, they look at this amount, right? So this is the number they actually are looking at. I only pay taxes on $36,500. That $3,500 that I took away, I get to keep that whole thing not taxed. Okay, so how much do I have to pay in taxes then, right? That's the big question we're really interested in. Well, what was the process? Deductions first, check. We already did that in B. Step 2, apply the percentage. So I do that here. 4.35% of $36,500. Okay, so again, it's just like doing sales tax. This is exactly the same step as sales tax. So how do we do this? We apply, just like sales tax, our percentage, 4.35%, to our taxable income, the $36,500. And we do this just like sales tax. We turn our percentage to a decimal, multiply by our taxable income. We end up getting $1,587.75. Okay. But that's not all. It's not all, right? That was step 2. So this was all step 2 in my previous 3-step process. I still have my tax credit. We get an extra $800 off at the end. So my step 3 then, take away your $800. Remember, it's taking away because it's helping you. This is all money you have to pay. So to help you, we should be trying to subtract away. So that ends with $787.75 to pay. Okay, so what's my net income? Well, my net income is my gross, what I started with, my salary to begin, minus how much I have to pay in taxes. $40,000, that's my gross, minus $787, that's my tax. I end up with $39,212.25. That's how much I actually get to take home after I've paid the taxes. Now, you might have other taxes on top of this, and that's something we have to talk about. But for this example, we only have this one state tax to pay, and so we end up with $39,000 and some change. All right, now, what about my effective tax rate? Well, remember, my tax rate was 4 and some change percent. But I didn't actually take $40,000 and apply that. I got to lower that amount by doing a deduction and a tax credit. So what was the formula? Remember, the formula was how much you pay in taxes divided by how much your gross income was. So I take my $787, divide by my gross of $40,000, which gives me almost 2% effective tax rate. Okay, so part F is asking, well, what the heck happened? That's not the same as the tax rate that I first started with of 4.35%. Well, what did you do? You got to lower your income in terms of what you're going to get taxed on. So going from $40,000 down to $36,000, remember, we've done this in Unit 1. If you take a number and then you try to do a percentage of it, but you actually then take a smaller number and do the same percentage, that will get smaller overall. So 4.35% of $40,000 is going to be different than 4.35% of $36,000, right? You have a smaller number to start with, so you have a smaller than number when you do the percent. And on top of that, you also, remember, subtracted more for your credit. So you not only had to pay an overall less percentage because of the deduction, your starting amount was lower, you do have a tax credit, which made your end amount lower. So overall, those two things lower your effective tax rate. Okay, so we've got another example here, example 2. Try it again. I get a job which pays $95,000 per year. I have a tax deduction of $9,200 and a tax credit of $1,300. My tax rate, my flat tax rate, is 5.4%. So same idea. We got a gross income of $95,000. That's what I start with. Okay, what's my taxable income? Well, take your gross, subtract your deduction. Right? I take away my deduction. That leaves me $85,800. So when I go to apply my percentage, I only apply it to that smaller $85,000. So this is like our step 1 in our process, our 3-step process. Here is step 2. Right here. Apply the tax percentage, 5.4%. Right? Applied to $85,800, multiply them, gives me $4,633 and some change. If I had no tax credits, I'm done. This is how much I pay. But remember, the tax credit comes after. I have a $1,300 tax credit, so this is step 3. I subtract that to end up paying $3,333.20 in my income tax. So, a deduction, apply the tax rate, then apply the tax credit. Okay, so what's my net income? Well, my net income, remember, is gross minus how much I pay in taxes. That ends up being $91,666.80. So that's how much I get to take home after taxes. So, what's my effective tax rate? Well, remember, our tax rate was 5.4%, but I don't actually pay 5.4% of my gross, right? I pay a smaller amount. How do I figure it out? I take how much did I pay in tax divided by my gross. I end up with 3.5%. So the end of the day, after everything, deductions, after my tax credits, I only have to pay 3.5% of my gross income in taxes. Even though, when I first started, it said I get taxed at 5.4%. So because of these extra things, I actually only have to pay 3.5%. And again, just to say it over again, the 5.4% was only applied to a smaller amount, right? So I only had to pay 5.4% on my taxable income, right here, my taxable income, because of the deduction. Then on top of that, the credit lowered that amount even more. So overall, the deduction and the tax credit lowered the amount of tax I have to pay. So the overall percentage of my total gross income that I have to pay in taxes is lower than just my flat tax rate. So now we're going to move on to property tax. And when we do property taxes, we're mostly just going to focus on the calculation of them, right? We're not going to talk too much about each individual piece of the formula here. We will a little bit, but there are some resources on Lumen that I've posted. If you are really interested in what exactly is going on here, how this is used and why, then you can look at those resources and come talk to me if you have questions. But for what I'll ask you to do in this class, we're really just going to be calculating the property tax and making sure that we can do that with given information. Okay, so property tax. This is a tax usually levied by a city or county government on property. So most of the time you're thinking something like land, a house, things like that. So if you have one of those things, you own one of those things, then you are most likely paying property taxes. Okay? And so these taxes go into a lot of things. Most of the time, a large chunk of property taxes often goes to pay for schools in your local area. So that's one of the big pieces. But they can go into other things too. They can go into paying for your fire department, your police department, things like that. So it's a way for the town or other municipality to raise money for those types of services. It's a tax. So what we have to focus on is this formula. And this formula, it's always this formula. It's a flat tax in that there's nothing but taking the tax rate and just multiplying. But there's an extra piece here that we have to pay attention to. And so there's a little bit extra than just the flat taxes we've been dealing with so far. Because there's actually 3 pieces here. The tax rate. So we're used to that. We were just dealing with that. There's the market value, which you just think that's the value of my home. Okay, I got that. And then there's this thing called the assessment level. And so what the assessment level does is it tells you when the tax person's coming to take the taxes away, are they going to look at the entire value of your house right here? Or has it been decided that, no, we're only going to consider half the value of your house? We'll just tax you on that, not on the full thing. That's something that different places do in New York State. Some states, it's the same everywhere. In New York State, it varies depending on where you are. So, assessment level. How much of your actual house do I care about looking at? What percent? Do I want 100%? Do I want to look at the whole value of your house or some smaller amount? Market value, that's just what is the value of your house. Tax rate, that's the percentage tax I'm going to apply. So this one chunk here that you can calculate, multiplying these two numbers, that's often called the assessed value. Okay, so let's do this. Let's just do it. The property tax. So here's an example. Let me zoom in a little bit more for you here. So Lewiston, this is a town in New York, has a tax rate of 34.62 mils and an assessment level of 84%. Use this to find the property tax for a $200,000 home. Okay, mils, what is that? So let's just stop and think. We can figure that out by just looking at this. 3 pieces I need here, right? A tax rate, an assessment level, a market value. I see assessment level, check, I've got that. I see a value of my home, check, I've got that. So then this thing mils here, that must be my tax rate. And so this is one extra little kind of curl that comes into things when you're dealing with property taxes. Sometimes it happens that the tax rate, so the tax rate here, that we're used to is just a percent or decimal, right? But sometimes it's given in mils, which is just a little bit annoying, but it's okay because it's pretty easy to get the percentage or decimal out. So sometimes your tax rate is given as mils, like it is here, 34.62 mils. So what do we do then to get to the percent? Because this says decimal form. Give me a decimal form. So here's what we do. This is all we got to do. Ready? We take our mils. So let's get ready for it. Here's our mils, 34.62 mils, and we divide it by 1,000. This would be 1,000 means move the decimal place 3 times. 1, 2, and then 3. So let's do it. 34.62. I'm going to move the decimal place 1, 2, 3 times. So this is 0.03462. That's my tax rate. My tax rate is 0.03462, which, if you want to convert this to a percent, you can do that. That's about 3.5%. If you'd rather think of it as a percentage, you could do that. So mils, I take mils, I divide by 1,000. That gets me to my tax rate. So what do I have? I've got my assessment level. So we could do a little coloring here. Can't stop coloring. Too good. Assessment level, that's right here. So that'll go in my formula. Tax rate, we just figured that out. That's right here. And then we've got the market value here. Okay, so we've got all those things. Plug it into our formula. Property tax equals, I put the mils over 1,000 times the assessment level. What did I do though? Be careful. This is given as a percent. Decimal form. 0.84 times market value, 200,000. I put that in, and I get $5,816.16. So something that I didn't do in the first formula that we should be careful about, let's do our unit check. Our units. None. No units there. No units there. This is dollars. So then the only units I have in this problem are dollars, and so of course I should get dollars back. So just a nice little double check for yourself. Okay, that's it. So that's property tax. Now, of course, just like in the taxes before, right, just as above, we can find the effective tax rate. So the effective tax rate, remember, just like we did above, take the amount of money that you were being taxed on, the $200,000, that goes on bottom. That's the total amount of money that your house is worth. So this would be your total market value. This would be like your gross income above, right? Just the flat amount. How much did you make? Then on top, you put the property tax. This is the property tax. How much did you actually have to pay? When we do that, we get this number out, 2.91%. So what is this telling me? It's telling me that I had to pay property tax of about 3%, less than that, 2.9% on my $200,000 home. Now, what this is really saying is that it could have been like I just took 2.91% of 200,000 to start. That's what this is saying. It's saying that's the same thing. But, I actually went through a few different steps to get there. So that's just like above with the effective tax rate before. If you've got a deduction, right, that's changing how much I'm actually taxing you on. That's what this is, this assessment level is doing. It's almost kind of like a deduction where it actually lowers the amount that you're actually being taxed on. And so at the end of the day, the tax rate isn't exactly what you paid. You only paid this effective tax rate on your whole big market value of your home, or above on your whole big gross income. So that's it. That's all we got to do. So property tax, that's how you calculate it. Okay. Again, though, right, just like above, we can talk about, there are deductions, things like that for property tax. There are things that can happen. But it's the same process as above. It's all the same, right? Deductions first, apply the tax, and then credits. Deduction, tax, apply the credit. You get that order down, you take things step by step, and these problems really aren't too bad to do. So, any questions, let me know.